Alright, Stock Market for Beginners 2020. Let's go, guys. It's your boy Colin Dinsmore coming at you with a brand new video about the stock market. So, the stock market is something that most people want to get into, but really don't know exactly how. And in this video, I'm going to talk about the best way for 99% of people to get in the stock market, and that is index funds. Through index funds, the most common type of index fund tracks something called the S&P 500, which the S&P 500 is 500 of the largest companies traded on the NASDAQ and New York Stock Exchange into one investment. This is a market cap weighted index, so typically the larger companies such as Apple, Google, and Amazon, they're going to have a larger portion of the market share compared to like the 400 largest company on the list. So it puts 500 stocks into one investment, which provides a great opportunity to have a diversified portfolio. And it's a very simple way to invest because it's kind of a set it and forget it type of investment. You typically just buy this fund because it's a fund. You typically don't want to sell in and out of this type of fund. You typically want to buy and just hold and keep on adding to it, especially because this type of fund pays a dividend, which I'll get into that later. So let's talk about the advantages of this type of investment. So this investment tracks the general stock market, which means when you see on the news, definitely on the news, when they talk about the stock market, they're usually talking about the Dow Jones or the S&P 500. Those are the two most common indexes. The other one is the NASDAQ. But the S&P 500 is probably like what is considered to be the most valuable index because it tracks a very broad array of companies, as opposed to Dow, which only tracks 30 companies, and NASDAQ only tracks 100 tech companies on the NASDAQ exchange. So the S&P 500 is considered, basically when people talk about how the market is doing, they're talking about the S&P 500. So basically you're exactly matching the market returns. So if you have like for example, if you invest in a different type of mutual fund that wasn't an index fund, that didn't track this index, basically you wouldn't, even if you saw how the market was doing on the TV, you wouldn't know exactly what your investment is because your fund could be doing many different things than what the actual market is doing. So with this, you're guaranteed to get what the actual market is doing when you see it on the news. So the next reason to buy into index funds is because they outperform most mutual funds in any long given period. For example, one very famous bet, has to do with mutual funds, but it had to do with hedge funds, was Warren Buffett bet a hedge fund manager right before the 2008 financial crisis that the S&P 500 index fund from Vanguard would outperform any set of hedge funds that he picked, or any individual or set of hedge funds. So this fund manager picked a fund of hedge funds, and throughout this 10-year bet, Warren Buffett won by a landslide. So that's just one example of an S&P 500 beating a set of funds. But when we look at someone else like the founder of Vanguard, John Bogle, he wrote a whole book called The Little Book Common Sense Investing, which basically just talked about the fact that 97% actually of mutual funds could not beat the index fund over any long given period of time, even sometimes before fees. And this even includes survivorship bias. So this includes funds that, like the funds that died off, that weren't successful, actually weren't counted into this. So this only includes mutual funds that stayed alive. So the number is actually even lower. So the fact is most fund managers, even before fees, can't beat the market. And that's another reason we're going to talk about that you should buy index funds, is because the fees are so low due to a low expense ratio. When buying any type of stock fund, there's going to be something called an expense ratio, which basically shows the cost of owning the fund for a given period of time. Most traditional mutual funds have expense ratio of 0.5 to upwards of 1% expense ratio. So basically for every $100, you could be paying 50 cents to $1 a year, which on the outset, to most people, that might not sound a lot. But when you think about the price of an index fund, the expense ratio on that is 0.004%. So the actual cost is astronomically times lower. And one of the biggest reasons that people tell you to get in the stock market is you need to get in early because of compound interest. Well, compound interest works both ways. Compound interest works, obviously, that if you're putting money in, you're going to get more money the earlier you start. But however, compound interest also works on expenses. So if you're paying 0.5% expenses, you're paying that every single year. And that compounding will just eat away at a lot of your gains. So paying a simple fund that has a very low expense ratio will definitely help your gains, because you're not giving your money away to a fund manager. You're putting more of your money towards the actual stocks, toward actual market value. And that's what's important in the stock market, is to have that market value. So that's why a low expense ratio is important, because you're actually putting more money in those stocks. Now we're going to talk about performance throughout history. So the S&P 500 has performed around 8 to 10%, 8% adjusted for inflation, around 10% per year. It's hard to give exact numbers because it varies, and there's different metrics used, and there's also dividends. For example, currently, if you were to buy a fund, S&P 500 fund, you get a 1.8% dividend. So even if the stock market is going down, you're still including those gains, and these gains include those. But basically, average of 8 to 10% is it's a very conservative number when it comes to investments, but it's a very safe number when you think about how much that really compounds throughout the whole years, because 8 to 10% may not sound like a whole ton. When you get a compound interest, an investment of $10,000 can turn into over $100,000 in a matter of like 20 to 30 years through compound interest. And that's if you don't add anything, if you just leave it by itself. So again, compound interest works this ways, and the average return is important, because sometimes the stock market is doing worse, sometimes it's doing better. For example, in 2019, the actual return on this fund I'm talking about was 30%, which that's an astronomical gain. That's an amazing gain, but that's not something you should expect every year. That return of 30% just shows the possibility of what this fund can have. And again, don't expect a 30% return every year. In fact, that's probably not even going to happen this year. However, it just shows that there is going to be years where it goes way higher, and then obviously in something like the 2008 financial crisis, there's going to be a lot lower of gains. You're probably going to be losing money in those years. But the average return is 8 to 10%, and that's what's really important. That if you leave it in there for that time, that will be the average return you will receive. One benefit index funds is, I believe, it diversifies a portfolio for every investor. Now, me personally, I also like to invest in individual stocks. Like I'm saying, the reason I'm saying this is the best way to get in the stock market for beginners is because this isn't an investment you have to like manage or worry about. You just kind of set and forget it. But even if you are a person who likes to choose individual stocks, I believe you still should have index funds in your portfolio, as you should still have a kind of passive investment that you don't worry about. And again, it further diversifies your portfolio, because if you're just buying individual stocks, it would be a pain to buy 500 individual stocks. But through one investment, you can buy 500 individual stocks. And if you're buying a total stock market index, that can get into 3,000s of stocks, where you're including large, small, and mid-cap stocks. Typically, the S&P 500 is only large cap stocks, so like the biggest companies. But again, these types of index funds diversify your portfolio. All right, now let's talk about which types of funds you can be buying. So right now, one of the most popular ways to buy these are through ETFs. So for the S&P 500 ETF, the most popular one is SPY or VOO. SPY is the Spider S&P 500 ETF, and VOO is the Vanguard S&P 500 ETF. People like buying ETFs because you can buy them through any time of the day. So that's one benefit of buying an ETF. However, you can also buy it through a traditional mutual fund, which one that I really suggest is the Fidelity 500 Traditional Index Fund, which that ticker symbol is FXAXIX. The reason why I kind of suggest this one is because it has the same low expense ratio as other funds, but you can literally invest into this fund with $1. You can buy 500 stocks for $1. It's insane that the investing has become so easy nowadays that you can literally buy into a fund with 500 stocks for just $1. And then if you want to get, I'll just name the ticker symbol of one other total stock market ETF. If you want to get into like the broader market, that's VTI, which is the Vanguard Total Stock Market ETF. That one's also really good. So there's just a lot of options if you want to get into index funds, which again, it's the best way to get into the stock market for beginners. So yeah, that's the video. All right, I want to thank you guys for watching this video. My name is Colin Dinsmore. Like, comment, favorite, subscribe, hit those bells, and I'll catch you with another video next time. Thanks a lot, guys. Peace.